And now the buyers who are buying are trying to cover. There could well be some hedge funds here trying to cover right now very quietly and get their stock back, buy stock back, buy stock back. They might be losing $3, $4, $5 a share on this buyback right now. Their average might be 15, 14, 16, and they're buying back at 21, desperately trying to buy back so that they can cover. Because once this announcement is made, everyone who is short stock is short warrants, and everyone who's long stock is long warrants. And now here comes the insiders of the company and friends of the company saying, we're exercising our options. Could it be possibly? Again, I'm just going to throw this out there as I don't know, a brokerage firm from Wall Street might well say, we're buying every warrant. We'll exercise every warrant that the street doesn't want as a backstop to this deal. Now, if that happened, oh my God, the short sale, the short squeeze is complete. In other words, the shares could run to double the price of the exercise price. So if the company is saying we'll issue stock at 30 a share, 3-1, 3 warrants, you can buy stock at 30. That lets us issue 100 million right at this level, brings us $3 billion. And a brokerage firm in Wall Street, an investment banking firm, says we'll exercise every warrant that the shareholders don't want to exercise. They're playing a calculated game. Yeah, they're screwing 65 million shorters. That's where the money is coming from to make this deal done. The brokerage firm will not have to exercise any of the warrants. The street will exercise all the warrants to cover themselves. That will actually be the issue. Now, in the derivatives market, I have no idea how that's going to play out, because that is the Wild West, going in and going out and everything in between. But there could be a rush of outsiders coming in here to pick up the stock once they realize the position they're about to be put in by the corporation. This is where this could get really insane. And I say kudos to Ryan Cohen if you're thinking along these lines. This is a no-brainer, a way to raise billions of dollars for nothing by screwing these short sellers who are trying to screw you. I mean, look, it's nothing personal. It's just business, okay? Shorters are saying this company is going to zero. They're a loser. The company is saying, yeah, here's our 13-week, here's an update report on our first quarter. We're going to lose around $20 million so far, but we have $1 billion in cash. Oh, and we've cut our expenses by $50 million this quarter. This is what the street doesn't also fully appreciate, is that they are actually cutting their costs more than what they're losing in sales. Why are their sales down? They're closing stores. They're closing the losing stores that they have versus last year. This comparison that you're seeing on this press release this morning, if you're reading it, the press release is comparing the first quarter of this year to the first quarter of last year. Last year they lost, was it 100 million in the first quarter? This year they might lose 30 to 40 million. So their losses are shrinking as their expenses are shrinking, as they're closing underperforming stores. They're actually improving financially. And this is where the street is lost in the fog. They don't get it. They're thinking, oh, well, yeah, this company is definitely going out of business. Well, if it's going out of business, why are they trying to raise money? Why would they even bother doing a prospectus? To try to survive? They don't need to survive. They got $1 billion in cash. There's no issue here.